Good afternoon, everybody. Thank you all for making the time to attend the panel session today. I'm Liam Cunningham, the Acting Deputy Director in the Banking and Insurance Division, and I'll be comparing the panel today. On the panel, we have David Cutter, who is the Chief Exec of Skipton Building Society, and he was previously the Chairman of Skipton International here locally. We also have Eric Barnett, who is the Chief Executive of Kleinmont Hambros, based in London, and he's currently the Chair of SG Kleinmont Hambros Channel Islands business. And also, as you mostly know, Jeremy Quick, who is the Director of the Banking and Insurance Division. So, if we, okay, we'll move on to the panel session. So, gentlemen, to start with, talking about innovation, how do you guys feel that the retail and private banking is going to change in the next 5 years due to the technological innovation, and how will the current players survive in that environment? Retail first. David, if we start.
I'll go first. Technology and innovation. There's so much technology and there's so much stuff out there, and the board asks, what's your digital strategy, etc. And I always respond by saying the most important thing is to get your business strategy right, and then how can technology be an enabler to do that. And just in terms of a bit of background about ourselves, we are a UK building society, about 20 billion of assets. We don't do current accounts, but we do obviously a lot of retail deposits and mortgages, and we also provide financial advice. And probably the biggest changer that we're seeing is how we can use technology to lower our cost of distribution. So I think for all banks, building societies, boards, the most important thing is to know what your strategy is at a business level, and then how can technology enable that. And as I say, the biggest change this year we're seeing is in terms of our distribution to our customers. They want to deal with us through our 88 branches, or over the internet, or over the telephone, and they can do that by different methods from one day to the next. But providing financial advice is very expensive. You've got financial advisors who get stuck on the M25 and they can't find somewhere to park, and they're not cheap, these people. So we've introduced, for example, this year, we're about halfway rolling it out to every single branch, video technology. So a customer, either from home or going to a branch, can speak to a financial advisor in another branch, or at the central hub, or at an advisor's home. So all those permutations to provide financial advice or mortgage advice is really driving down the cost of distribution and making it far more easier for our customers. And our probably number one mantra at the moment from a technology play is how can we make life really easy with our customers, whether it's on the internet, through the telephone. So, innovation, there's so much stuff out there, and people say, who should you get into bed with in terms of the fintechs, and we do scan the market and try to see who the winners and the losers might be, but it's very much trying to identify those who are relevant to our business. And as I say, the biggest change in our business is probably coming through on the use of video technology for distribution.
Fantastic. David, do you have any opinion on kind of how open banking is going to affect a business like yours, or retail business across the...
it's very early days. As I said, we're not a current account provider, so we are watching and seeing. It's coming in the new year. But I think consensus is nobody has a real idea of how this is going to change things. But there are big opportunities as well as some big risks. On the mortgage side, just that sharing of data means that I think it's just another way that the whole mortgage, the sales and the underwriting process just gets quicker, slicker, faster. So I can see opening banking helping us as a lender, but I just see that part of the sort of evolution rather than a revolution. On the savings side, there's obviously a concern that if a customer gives approval to a third party to, in effect, take ownership of the decision making in terms of where they should place their money, that could create a threat to our savings business. Actually, I think from our type of customer who's naturally a bit older, as I say, we're a savings institution rather than a current account provider, I think they'll actually be quite reticent for a number of years in terms of doing that. So I don't see that as a threat to begin with, but it's very much watch and see. So it's early days, nobody knows, everybody's watching and seeing. We're not complacent. I think from our business we've got some time, particularly with our savers. But there's billions of money with the banks paying ridiculously low interest rates. In theory, they're the ones that could be at risk first.
Eric, with regard to kind of private banking, how do you see that kind of 5-year horizon for technical innovation kind of affecting you?
I agree with David that it should be seen as an enabler to an existing business model. That once you've got the model right, you should use technology in the way to automate. And when we talk about digitalisation, we often really mean automation. That being said, and I hope I don't offend any private banking colleagues in the room, private banking itself isn't actually known for being at the cutting edge of technological innovation, and I wouldn't pretend Climate Hambros falls into that camp either. But part of the conflict we have within private banking is that when we talk to our clients, which we do, they say to us, we want you to have the most cutting edge online capabilities or full app capabilities for everything you do, blah, 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 blah. And then when we say, why do you actually bank with? And say, well, because we like the people. So there is that sort of inbuilt contradiction in terms of why people come to a private bank and how we automate it. I suppose in our business, probably the most talked about development and what will happen over the next 5 years is regarding robo-advice and how robo-advice can underpin or undercut what a private bank does. I mean, at the moment, I don't want to sound like being a board director of Kodak talking about digital cameras at the moment, but at the moment the amount of AUMs managed by way of robo-advice is a relative pinprick at the moment. That's not to say it won't happen, and I suspect over time the actual development of robo-advice will equalise towards the same advice, i.e. the algorithms underpinning those models will ultimately equalise, and then successful players will be those that have the most efficient distribution of their products and the best performance of the underlying investment. One of the things I struggle with a little bit at the moment when looking at some of the fintech robo-advisors is that they are more IT companies than investment managers. So I was talking to somebody from one of the best known ones in the UK, and they have about 7 IT engineers for every one investment manager. Clearly in a private bank the ratio is the other way round plus some, so I think that the market needs to find an equilibrium between what it wants in terms of delivering investment advice and investment products as opposed to a technology platform.
I think in terms of open banking, the one part of our market I think could change quite fundamentally is in terms of the mortgage broking market. So in our case, 95% of our business comes through brokers. UK average is about 70%. But I do know that some, there are new businesses which are getting into that space who are already well connected with all the lenders, people like Experian, and people like, in terms of the comparison website, Go Compare, and people like that, whereby if you think about it, motor insurance, credit cards, things like that in terms of price comparison websites, been around quite a bit. The mortgage market is the one that's the least mature on that area, but once you've got the connectivity between people like that, Experian, Go Compare, with all the lenders, and they plug in and they know what our underwriting rules are, it does raise the question, well, why do you need a broker? Because you can go on site, and these new platform aggregators are the ones that can then, say, well, just give us your detail, what's your income? Would they understand the lending rules of the lender and essentially come up with a list of what's best for you? And therefore, that might fundamentally change the broker market, who might then have to go into sort of niche, more complicated areas. But for the straightforward, vanilla, easy stuff, it could fundamentally change the mortgage broking market.
Sure. Jeremy, did you have any thoughts on...
Yeah. I mean, so the big players here are PSD2 and open banking. And I think we have to remember the origins of both of them. It's competition. That's the player here. I think if you talk outside the particular industry, open banking, PSD, people haven't quite got their heads around this yet. There's a lot of natural concerns about privacy, security, these new APIs that are coming in, no one knows who they are. The banks are trying to monopolize the position by buying technology firms or hiring people. So it's pretty early days. So I don't see this revolutionizing the world in near time soon. But, and it's interesting to hear the views of the current occupiers, because I think there are a number of ways this could go. It could be that the current industry, a bit like aggregation in the 90s, just buys up all the competition, provides more services to consumers, and basically it's just a progression of the current status quo. That's one version, but I don't think we should necessarily discount the other versions, because right at the other extreme is that the new technology firms come in, small providers come in, backed by all that wholesale money that is around, and they basically devastate the current owners. And what that would mean is that the clearers, for example, who have been with us for over 100 years or so, they either disintegrate and smaller banks take their place, or they just become utility companies. They're just supplying the plumbing. And even Basel has published a paper looking at this possibility. Now, I'm not saying that's going to happen, but that's a pretty big change. And from a regulatory point of view, I think the regulators are beginning to sort of think through this one. First of all, you now have to regulate more technology bits, inevitably. Also, the firms become, what were financial firms, increasingly become technology-based firms. So the chief technology officer is probably sitting on the board. I mean, that's interesting. How do you relate to that? There are all these algos around. Do you regulate the algos? And we've looked at that here. And then also, if it is a period of change, and I'm not saying it's going to do, but if it is a period of change, for a regulator, there are all issues about profits, firms being taken over. It's a maelstrom. And I think the regulators are sitting there. I don't think that's the majority view at the moment, but it's possible. And one thing with technology is once you start it, heavens know where you're actually going to end.
Certainly. We've spoken so far a fair amount about kind of distribution networks and that side of the innovation market. How do you think IT is going to change banks internally over that same period?
I'm slightly worried by Jeremy's description of David and I as the current occupiers. It's obvious. We banks need to invest heavily in systems to automate what is currently very, very manual. I'm very impressed by your use of video technology to deal with your clients. Certainly at the smaller bank level, like our bank, we've got 1,000 people in 4 jurisdictions. So we are a small player. We have to use IT to enable us to overcome what are currently very many manual processes. And the development of regulation, particularly in the last 10 years, as we all are aware, has put increased burdens on the business. And I hope the pendulum will, at the moment we're dealing with a lot of those in a manual way. We're trying to automate as fast as we can, and I hope the pendulum will swing back over the next 5 years and that will become more seamless. But for the minimum size to be viable as a private bank, as I was talking to McKinsey's about this, they basically said that it's doubled over the past 10 years. So what they were talking about in terms of asset size, 5 billion in 2007 is now 10 billion and possibly going up to 15. So the only solution is automation.
Yeah, it's interesting because IT should be a sort of saviour in terms of trying to help reduce the costs and the total cost of ownership of a business. But they're also, particularly the bigger banks, have the conundrum that they've also got to support a legacy system as well as building a digital platform. So on the one hand, they're being asked to automate and make things efficient and cheaper, but on the other hand, they're actually having to support two systems. And then you overlay that with the real increase in the need to demonstrate to yourselves and the regulators in terms of operational resilience. And yet it's putting a lot of costs, more costs onto all our businesses. So they've got their own challenges, the big banks, as a result of IT. You know, and it is the one part of the organisation where the costs are, however much you try to sort of make things efficient and cheaper, you just keep putting in new layers of, you know, security, IT experts, digital platforms, etc. So it's a particular problem for the big banks because they've got this conundrum of trying to, in effect, look after two platforms.
Moving on to international standards, I think it's fair to say that some commentators have suggested that since 2008, reforms in banking standards, some people have said gone too far, in both prudential and conduct business, or both. Would you two have any comments on where you think international standards are and whether they've hit the right level?
I think in a forum organised by the Guernsey Financial Services Commission, I'm not going to say regulation is too light. I think on the prudential side, I would say it's probably about right now, and I think that's probably what the PRA would say. On the conduct side, if anything, it's been more difficult, but I do see some differences on the conduct side in terms of international approach. I think some of the European regulators are more focused on, in conduct terms, the health of the bank as opposed to the outcome for the clients, which in my experience has been probably more the priority of the FCA. But certainly on the prudential side, for me, I don't know from a more retail angle, but from my point of view, prudential is probably about right, I would say.
If I'm being honest, I can't answer that question. Ask me after the next recession. So there's obviously been a huge amount of change at the international level and more locally. It's complex. By crisis, we're just about to submit our ICAP to the board. It is really complicated now, and trying to get your head around it. Whether it's gone too far, I don't know. Honestly, I don't know. I mean, the tools are there. We've got the added challenge in the UK. We've got two regulators in terms of prudential and conduct, and then, when you add on the fact that still some of the rules are yet to be finalised, so we're still waiting to see, where do the IRB laws land, and our own firm is, I think we're the smallest in the UK that are caught by the MREL requirements, so we have to have bail-inable debt. Anybody smaller than us goes through the insolvency regime. Those rules have come out, we know what they are, but they're still in a flight path, and even from 20 to 22 onwards, they're going to sort of check and recalibrate them. The leverage ratio, which was brought in as a backstop because regulators had concerns over IRB models and how robust were they, has moved from being a backstop to being actually probably the biggest inhibitor in a lot of businesses. I think they call it a guardrail now. It's not a backstop, but it's now very complicated to sort of calibrate your capital requirements, your MREL and your bail-inable debt, as well as your leverage ratio. So there's a huge amount of complexity. The rules are still not yet finalised. This is taking place at a time when we're facing intense competition and very low pricing in the UK mortgage market. As I say, we haven't gone through a recession yet, so ask me after the end of that. No, I think the jury's out. Yeah.
I do agree. I mean, what I would say isn't helpful is where there are differences between jurisdictions in terms, for a small bank like ours, where we're running 3 different banks, to manage subtle differences between 3 or 4 different jurisdictions with the same people doing it is very onerous, even if it's very difficult to manage, as you say, an ICAP process or an ILA process where you're having to deal with a different regime in each time and then consolidate it. And I think the other thing in terms of what your point, David, is recovery and resolution I don't think has really been tested yet, which we'll only really know, I guess, post the next recession.
Talking of recovery and resolution.
Yeah, no, I mean, I agree with everything that's been said. I mean, the next crisis will probably not look like the last crisis, so it's difficult to create a regime that's going to be appropriate. But if you look at before the last crisis and Basel, you know, they didn't have a liquidity policy, they didn't have a large exposure policy, and there was perhaps too much reliance on models and so on, and leverage wasn't really talked about. Now, Basel covers all those areas, and I think that's a far more complete menu for national regulators to look at. Two areas where I think work is still in progress, and I agree. One is cross-border resolution in particular, not quite apart from national resolution, how regulators will operate in a resolution across several countries. Generally, this hasn't been tested either in theory or in fact much at all. The other one, I think, is non-performing loans, because the accountants don't really cover that space very well. It's got to be the regulators, and of course, for the regulators to do that, it's quite controversial. So I don't think this is an issue in the United Kingdom, but it's an area that I think is a bit of a gap.
Yeah. Thank you, Jeremy. You touched on non-performing loans there, and moving on to mortgages in general. I suppose this is more for David than for Eric. But what's your view on the UK regulator and whether it's got its level of mortgage regulation correct?
Yeah, I mean, there's been a complete sea change in recent years, and I think they've got that about right. And it's not. It's not just the regulator, it's also they've introduced the Financial Policy Committee, which is looking at more macro impacts and has requested for and been granted some tools, some of which it's deployed. So it's a combination of, I think in particular, the introduction of affordability stress testing means that, you know, the days have gone of liar mortgages and things like that, and irresponsible lending should be a thing of the past. So, you know, there's been a lot of change in that space, and there's, as I say, the FPC's introduced rules in terms of we now have to limit the amount of high loan-to-income ratio, a certain proportion of that, and so yeah, I think they've got it about right. You've got the boundaries of sort of unregulated and regulated. Is an area which I'm not too sure they've got right. And interesting, this is one for the prudential regulators. We went through an exercise this year of de-risking by selling one of our non-performing adverse books. And that's clearly a very good de-risking exercise. So from the PRA's point of view, it's great, go ahead and do it. From the FCA's point of view, they absolutely hate it, because the people who are buying those assets are outside the regulated regime. It could be private equity banks, people like that. And typically those customers are the ones who are more vulnerable, who have been, and clearly by definition, have been non-performing. So you do see this real tension, which I don't think has been squared off yet, in terms of where's the regulatory perimeter. And on the one hand, you know, you've got the prudential regulators saying, yeah, it's a great de-risking exercise, and on the other hand, you've got the conduct regulator who absolutely hates it. And my response was, don't blame it on me, go and talk to the Treasury who sets the rules.
Jeremy, what's your view on that?
That sounds... Sorry.
I was going to say, especially kind of maybe the Guernsey context on that as well, of where we are on mortgage regulation.
Yeah, well, I think actually, hearing David talk, it talks like securitization all over again there, in terms of the interface with the actual holders of the assets. But I agree. I think clearly the setup of mortgages before the financial crisis was a mess in the UK, too reliant on LTVs. We've now got affordability. I think there is a frustration, I certainly think we feel this here, that the process of actually getting a mortgage is long drawn out. And I think that's possibly providers gold-plating the process, possibly because they're afraid of the regulators. And I think we never quite get that message over, that we are interested in mortgage supply as well as it being done correctly. It's interesting, I think the mortgage side is only a part of a bigger story about which perhaps people haven't quite totally focused on, and that is the abandonment of the interest rate as the sole area of monetary policy in the UK, because the FPC actually has got power now to determine mortgage lending on macroeconomic grounds. So it's a little bit like a sort of monetary tool, and that's true with other areas. Not sure it's used that yet, but those powers are available now in a way that they weren't before. I mean, I think in Guernsey, I share the view that we haven't got enough mortgage suppliers here. I think there is money to be made, to be honest, and somehow people should be encouraged to come in. Interestingly, if we link it to the first question, innovation, if we do go down the route of APIs, you could actually see an increase in credit supply to slightly out of the way places like Guernsey through apps. So instead of trying to entice mortgage suppliers to come here physically and all that, Guernsey people could just get on an app and get a mortgage loan. I mean, that could be the case in a few years' time through open banking. So, you know, that may solve some of our problems.
Yeah, fantastic. Thank you. Eric, moving on to something that's maybe slightly more London-focused, but we'll put a Guernsey context on it as well. What do you think the impact that Brexit is going to have on London's position as a global wealth management centre, and specifically how that's affecting the private banks in London?
Well, it's obviously a very big question, and I don't know the answer any more than anybody else.
No.
But if you ignore the movement of staff from some of the big banks to the continent to cover their passporting requirements for them, which I think will be relatively manageable, the success or otherwise of, or the continued success or otherwise of London as a centre for high net worth individuals to have their assets managed or indeed to live will largely be dependent on I think the success of the UK. I mean, I'm a relative optimist because I have to be, because my business is there and here, and we're very dependent on that to happen. But at the moment, I haven't particularly seen any decline in the number of people, I haven't seen any notable trend of people leaving the UK from our client base. I don't know who hasn't come who might otherwise have come, but things like the non-dom regime are not Brexit dependent. The rules on that change every year anyway, generally in a tighter direction. So non-DOMs as a number have been declining over a number of years, but that's quite often because of non-DOMs becoming DOMs rather than leaving. Our business is not particularly dependent on the EU. Most of our clients are either UK resident or not EU residents, so I'm relatively confident from that point of view. And otherwise, it'll then depend on the success or otherwise of the UK economy, which your view on that rather depends which side of the fence you voted on, I guess. But,
and do you see that there's been much difference in the reaction or the view of, say, European private banks versus the US colleagues that are based in London?
I think for you, not so much private bank, but European banks v non-European banks, there is obviously a very strategic difference. I mean, our business is owned by Société Générale, which is obviously a French bank. They don't need London to passport anyway, so they use London as a base for market activity, etc. For them, in one sense, Brexit doesn't really make any difference. Or very little difference other than at the edges. For the Americans, which have been using London as a means to passport, both in London and in the rest of Europe, it's a bigger strategic decision. But it's quite interesting. I've seen a little bit. I'm not a soothsayer on this, but some of the recent press articles have seen some rowing back of the initial forecasts of jobs being moved abroad. I think UBS, for example, UBS HSBC, I think, pulled back a little bit from their initial forecast. So early days and we'll see. But I think that in itself shouldn't be overplayed as the impact for London as a centre for asset management, high net worth management. No.
Jeremy, do you have any comment on how you think the clearers are reacting in this same market?
Well, I think retail subsidiation has already happened in the UK, irrespective of Brexit. The UK banks, large ones, will have no difficulty getting licenses in the EU and already have done. But inevitably, they will have to subject to transitionals, they are looking to move European business out of the UK site into a European site. And that will be, as the Germans have made perfectly, that must be mind of management and substance. So inevitably, that means some of the business from London will move into Europe for European business. That will diminish London.
Certainly. Given what we've spoken about so far, so innovation, the international standards, as well as Brexit, what kind of strategy on banking do you think Guernsey needs to adapt to make sure that we grow our banking business, or at least protect what we have as a banking industry?
You mean on private banking? Or,
yeah, we'll start with private.
So for private banking, I think Guernsey has to follow the path it's followed, which it has no choice but to be at the various highest common denominator of regulatory standards in every respect in terms of prudential conduct, transparency, etc. But all the advantages that Guernsey, we all know Guernsey has in terms of the infrastructure, the time zone, the English language, none of that is, as far as I'm aware, changed by Brexit unless we're going to move it. And so I think Guernsey still has a very valuable role to play in the management of international wealth, as it has done for the last 2 or 3 decades.
Excellent. Jeremy, do you?
Yes, my own thoughts. We are fighting against very tough headwinds, there's no doubt about that, largely to do with the huge diminution of cross-border service trade compared to 10 years ago. Nothing to do with Guernsey, it's just a global reality. I think we have had one BRIC bank open here, and I think that potentially is the area that we should fish in, the BRICS, which includes, of course, China.
And David, do you have any view on how best to adapt and grow, maybe from the lending side or from anything more touching the retail savings market?
I think as long as you're relevant and you're giving good proposition and service to your customers, there's no reason, certainly in the retail space, why businesses can't thrive. So, for our own, that means great services to brokers or direct to the consumers themselves in terms of the lending side, and on the retail side, which is very diverse around the world anyway, there's no reason why that can't thrive. But as somebody who lives in the UK, I think it's, as Eric said, it's fundamental that the standards are kept very high, the reputation, anti-money laundering, and you keep retaining and attracting talent, because at the end of the day, that's what the economy will thrive on.
We have, as mentioned yesterday, one of the questions yesterday was regarding the decision of the EU on their own blacklisting, and that I think that's a relevant concern at the moment. We hope that goes the right way, as it should do.
Excellent. Now, I think what we'd quite like to do now as well is open up the floor to, given that we've got the panel we have, to any other questions, to see whether there was any particular views or comments that people had.